If a company is everywhere, does that mean it'll make you rich? Most people treat famous like safe. That mistake can drain returns for years. Your brain loves shortcuts, and markets love selling them, but famous is not the same as profitable. Today we separate hype from math. Money is messy. I am not. I'm Maxwell. I help people make money decisions without falling for obvious traps. The bias is called representativeness. Plain English, your brain says, this looks like a winner, so you assume it will keep winning. You judge by the vibe, the story, the brand, not the price, not the math. Let me show you how this plays out in real life. Same bias, different people, different goals. I'll keep it simple. In a minute, you'll see why best company can be a bad investment. Same company, different price, different outcome. I have a client from Seattle. His name is Ethan. He's 29, works in software, makes about $110,000, and wants fast growth. He shows me a list of famous winners, the names you see on hoodies, billboards, and podcasts. His logic, they're obviously great. His brain saw a shortcut, winner, and it stopped thinking. So I asked Ethan one human question. Are you buying the company, or are you buying the crowd's confidence? Representativeness says it looks like past winners, so it must keep winning. That's pattern matching, not forecasting. It's like driving using only the rearview mirror. You see where you were, not where you're going. A great business can be a bad investment if the price is too high. Stocks aren't trophies, they're price tags. If everyone already believes it's perfect, the price may reflect perfection, and perfection is fragile. So we changed his plan. No all-in on any single story, even a beautiful one. Balance first, always. Ethan's takeaway was simple. Stop buying fame, start buying value and a plan you can stick with. Here's the scary part. This bias hits hardest when you're trying to be safe. That's when shortcuts feel responsible. I have a client from Columbus, Ohio. Her name is Danielle. She's 41, 2 kids, makes about $78,000, and wants stability. Her goal wasn't get rich, it was don't mess this up. College fund, emergency buffer, keep life steady. She pointed to a brand-named fund she'd seen everywhere. Ads, podcasts, friends. Her logic was, everyone recommends it, so it's safe. A long line doesn't guarantee a great meal. Sometimes it's just hype. Representativeness says it looks safe, so it behaves safely. But risk is not a label. Risk is what can happen next. So I asked 3 simple things. What's inside it? How concentrated is it? And what happens to it in a bad year? We did plain scenarios. If the market drops 25%, what do? Sell? Pause investing? Or stay steady? That's when Danielle saw it. She wasn't buying a fit, she was buying a feeling, and feelings don't protect portfolios. It's like wearing a life jacket made of painted foam. It looks protective, but it's not built to float. So we rebalanced. We matched risk to her timeline, and we kept it boring on purpose. Boring is stable. Her takeaway, safe is personal. Safe is planned. Popular is not a plan. Next story, someone chased a legend stock and forgot one word, price. That one word changes everything. I have a client from Phoenix. His name is Raymond. He's 62, selling a small business soon, and has about $900,000 invested. One glowing headline flipped a switch, the greatest company of this decade, and suddenly Raymond wanted in. Not a little, a lot. He wanted to move $300,000 into it. That's representativeness with a big dollar sign. His brain said, it's the greatest, so it must keep rewarding me. But markets don't pay you for headlines. They pay you for outcomes. Your brain crowns a winner, then it bows to it. That's how legend turns into automatic buy. So I asked him, are you investing or joining a fan club? Fans don't ask about price, fans ask for merch. Your return depends on your entry point. If you buy after a huge run, you may be paying for the past.
That's like paying new car money for a used car reality. Great vehicle, wrong price, bad deal. So we slowed down. We set position limits, we used a time-based approach, and we kept his retirement plan intact. His takeaway: retirement doesn't need legends, it needs consistency, and retirement hates concentration. Want a question that can save you $10,000? Ask this: what would make this sure thing look stupid next year? Your brain loves patterns, that's normal, but investing is not pattern matching. It's probability, price, and patience. Badges, stars, and headlines feel like facts. They're not returns. Price is the part that hits your wallet. Think like a shopper. Same product, different price. You don't buy it because it's famous. You buy it because it's worth it. Hype inflates quietly, then it pops fast. If you pay peak prices for peak stories, the drop feels personal. When you feel, "I can't miss this," pause. That's usually a sticker, not a strategy. Here's the fix. 3 steps. Simple enough to remember, strong enough to block representativeness when it shows up. Step 1. Pause. Give it 24 hours. Let the noise drop. If it's still a good idea tomorrow, you'll still have the button. Step 2. Ask 3 questions. What do they earn? What could go wrong? And what am I paying today for that story? Step 3. Size the bet. Even if you're right, don't bet like you can't fall. Good investing is controlled balance. Most damage doesn't come from being wrong. It comes from being wrong with too much money. Size protects you. Pause, ask the 3 questions, size the bet. That's it. That's how you stop famous from steering your money. Remember, famous is not a forecast. Great is not the same as worth it. Don't confuse trophies with price tags. Brands, funds, headlines, they're all stories. Your job is to check the price and the risk behind the story. Different people, same trap. Ethan chased winners. Danielle chased comfort. Raymond chased a legend. All 3 needed the same fix. Fame is loud. Numbers are quiet. Wealth is built in the quiet. Train yourself to follow the math, not the spotlight. When you hear "everyone owns it," translate that as expectations are already high. High expectations make price risk bigger. Money is messy. I am not. Don't buy the story, build the system. Stories change, systems compound. If this helped, hit like, subscribe, and share it with someone who keeps buying famous. It'll save them stress. And quick reminder, this is education, not financial advice. Do your own research or talk to a professional before investing.